break this if I move it up a bit. Here we go. Great. Okay, well, good evening, everybody. And great to see lots of familiar faces and be back here again. So, we usually like to start with a little bit of humor. This year was tough to find. And when you look back at the past 12 months, it's been a challenge. The Canadian stock market had a tough performance, no question about it, down 7%. But in fact, under the hood, the average stock was down substantially more than that. So it was a very tough year. And if you look beyond equities, there wasn't much of a return in bonds, as I'm sure you've seen, and preferred shares were beaten up really badly. There were a lot of preferred shares in Canada that were down more than a third. So it was a pretty tough year, and on the back of that, you'd hope you'd see Ottawa and Queen's Park get together and maybe think about reducing taxes, but they all thought they'd actually go the other way. Maybe you guys could explain that to me one day. And then, you know, Alberta is often a place that we've counted on as a have province that we can ultimately count on to have flush royalty checks flowing not only into their own treasury, but up into Ottawa to help out the rest of us when we're in tough times, but the flow's going the other way now, which is quite a new development for them and the rest of us, and they're even having to get used to higher taxes. So it was a tough year all around, but as this says here, even Alberta's having to figure out how to run on alternative fuel. The silver lining, perhaps, is that markets are beginning to show some signs of recovery, and particularly for Canadians in some areas that are very pertinent to the Canadian stock market. Areas that the Tradex equity fund isn't entirely dependent on, but it's good news that resource cyclicals are starting to get a little bit of life breathed back into them by the prospects that we may have seen the worst for oil prices and on some other commodities. So as we look for a moment back over the very long term, I think there's some, you know, interesting observations we always draw upon, and certainly in all of our minds, we're all here investing for the long term. There's no point owning stocks if you don't believe in at least having an investment time horizon of a cycle. So the good news is that over the long term, you can see it's been a very pleasing performance. And interestingly, despite how jagged the line is, you know, over the past 4 years, the Tradex equity fund has actually compounded at about 8%. So not too far off the long-term pace of 9.2, which of course includes periods of far, far higher inflation than we're experiencing today. So it's certainly been a jagged movement over the past decade and change, but it's been heading in the right direction. And when you look back over time, the other thing I think that you can see when you look prior to the dotted line where PH&N took over, or just around that dotted line, these small movements such as we're seeing, or these large looking movements such as we're seeing today, look rather small in the rearview mirror. So some interesting perspective, I think, when we look back. This gives you some sense of how did the fund actually perform last year. And so on a one-year basis, what you can see here is that the fund was down 5%. And as we talked about, the TSX was down just shy of 7%. So the fund was down 5%, not a satisfying year for investors to end up walking away with less than they started with, but that is part of the long-term risk-reward story in equities, as we all know. And I think in actual fact, if we consider all of the things that were working against Canada over the past few years, or Canadian stocks, we could actually argue that it's pretty surprising if you look at the TSX composite. Over the past 3 years, it was up 5%. Over the past 2 years, it was flat, and it really fell this 6.6% over the past year. When you think of the drubbing oil has taken, how dramatically the prices of all the metals are down, those big factors for the Canadian stock market. It's been a tough time all around, but it really has been a surprisingly resilient performer with everything that's been going against it. Perhaps the silver lining for all of us is that the Tradex equity fund continue to outperform the TSX Composite. And so in good and bad markets, when you look at the bottom line there, there's some continued outperformance. There's a very important underlying story that we'll continue to touch on over the course of the evening that plays into that, which is that all of you and your board and management decided a long time ago to allow your manager to step out of Canada when they felt it was timely and appropriate to do so. So having that global or that foreign equity exposure within the Tradex Equity Fund has been very, very important. Underlying, in Canada, stock picking has been going well. We've been outperforming the TSX over the long haul for Tradex, but it's also been really, really valuable to make this tactical allocation and get foreign equity exposure into the fund when we think the prospects for Canada are less attractive. How about relative to the competitors? And it's important to know that the peer group that Tradex is measured against is the Canadian Focus Equity Fund universe. And within that universe, managers similar to your fund can own up to 50% foreign equity exposure. So this is, an apples-to-apples comparison. There's quite a bit of variation in terms of what managers will actually do. But all of these funds in the peer group are not just Canadian equity funds. They very much have the same mandate that this fund has in terms of their potential constraint on foreign equity allocation. And the good news, or satisfying news, is even in a tough year in terms of absolute returns, again, we were outperforming the peer group. So again, we're seeing, at least from a report card perspective, so far, so good in terms of some satisfaction of outperforming the benchmark and the peers in good and bad years. Now to the look ahead. That's a history lesson, and what can we expect looking forward? Well, interestingly, when we were putting together these slides for this segment of the presentation, if you look back last year, you'd find in this segment, not much has changed. And in fact, it's reflective of something. The backdrop, ironically, shares a real echo with some of the things we talked about last year. On the risk side, there's still some very concerning items for all of us that are confounding lots of people, and that is we seem to be forever caught in this debt supercycle. Governments are constantly layering in more and more debt, or finding central banks printing more and more money, and of course it's confounding to know exactly how that'll evolve and continue going forward. But one thing we do anticipate is when there's more leverage in the system, there's more gearing in the system, there's more room for volatility. So the kinds of things we've seen even starting off this year, unfortunately, we're likely to be seeing more of that in the future. So volatility. The last few years were fairly calm up until we really started to see the volatility of the last sort of 12, 18 months. We do think that's a more normal expectation. And we were really in an environment post the credit crisis where we had the central banks anchoring the short end, really providing tremendous stimulus, and ultimately volatility is really tamped down. It was a lovely environment, but as we start to get past some of that excess stimulation coming out of the United States, we eventually expect that we're going to continue to see a move back to a more, at least normal, risk environment, and perhaps more elevated risk environment in terms of volatility. Deflation is a concern, and it's for all of us, we can say, well, why is deflation a concern? Geez, if prices stay the same or move down, isn't that good news? And if you're out shopping, it's great news. If you're trying to sell goods, it's terrible news, because you've got fixed wages that are laid in for years to come in some cases in terms of contracts. These are real challenges for corporations. So if you get deflation, it's bad news for the valuations in stock markets. And so there's this push and pull as to whether we're going to see enough inflation to keep earnings growing or not. Oil, you know it as well as anybody, but the good news is the fact is that there's a little bit of stimulation there from lower oil prices combined with low yields. And the one positive on the risk side is there's been so much currency fluctuation But the US dollar headwind, we still expect the US dollar to appreciate again, but the headwind does appear to have softened for the moment for many reasons. So that is a piece of good news. The implications, which we've really discussed, a couple others are, one manager's probably discussed the low yield environment and how that's, in our minds anyway, likely to sustain itself. The positive side to the story is that companies keep on finding ways to grow earnings. And if that can continue, and we can get a little bit of inflation in the system, we think we've still got a positive story for the stock market going forward. And we'll touch a little bit more on that. Oh, should have let you seen that, sorry. My apologies, but there's the other piece of the slide. In terms of another slide that echoes things we talked about last year, when we see the debate about the stock market, some of the simple high-level debate is around, well, isn't the stock market long in the tooth? Don't cycles normally end after 5 or 6 years? Therefore, are we due for a sort of a bust? And the other side, I don't hear very often, but there are a few optimists around that think there's a potential for an equity supercycle, such as we see every once in a while, where equities actually move forward for a really extended period of time, sometimes 10 to 15 years. So there's a small group that believes that. I think we're in what we think is hopefully a sober middle ground, which is, yes, if you do a raw count, on the left-hand side here, the current cycle is coming up on 7 years. Relative to a 6-year average, that looks long in the tooth. But when you think about the environment that we've seen in the past, normally you come out of a recession, you see much stronger growth that leads to a lot of complacency and ebullience and excitement, and we get an environment where we start to build inflation and things get overbuilt, and we really set ourselves up for the bust. Right now, we're 7 years in, and we still can't really get corporations outside of doing mergers and acquisitions too excited about the environment. They're not hiring like crazy around the world. There's been some good news on labor growth in the United States, but you don't see a tremendous amount of excitement. Everybody's got things sort of tightened down, nervously watching for the end of the cycle. And so there's a bit of a contrarian, optimistic story in this, because everybody still has scar tissue from the credit crisis. Hard to believe how long ago it was, but the scar tissue is still ever prevalent there. And it's keeping this cycle a little more buttoned down, and this slower growth has the potential to sustain itself further because we've got the central banks constantly pushing on the gas pedal, stimulating. We've got low yields. We've got balance sheets on the consumer side, believe it or not, in the United States that have done gone through a lot of repair, and we're seeing generally corporations behaving in a pretty practical manner and not getting too carried away. So we do think there's potential for more of the middle ground, which is seeing that after a financial crisis you can get a longer cycle. The other thing that, again, trying to stay relatively high level, we can point to is that valuations. There's always a lot of conversation about valuations, and we could certainly say ourselves that if you looked at the equity markets alone and you look at where the end point is here, you could certainly say, just from a simple perspective, that the price to earnings multiple, which is just a valuation measure, is towards that sort of upper ground. It's not at an extreme, but it's towards the upper ground that we've seen back to sort of the post-war era. So you could say that equities look fully, to fairly valued. And so that would be one conversation. But the other side of it is, when we think about what the yield is on a bond, and theoretically, if you, instead of thought about the yield on a bond and reverse that ratio, so instead of thinking about the coupon over the price, turn it around and think about the price over the coupon, which is basically what we're doing when we think about a PE ratio. Think about how fabulous that valuation is by comparison. It's an enormous valuation that's being placed on bonds, all for good reason. We're not here to speak to fixed income, but if you think about the comparative valuation on virtually any other asset class, equities are still offering a deal. And the interesting thing is, theoretically, we still believe there's room for earnings to continue to march forward. So we're still, hopefully not naively so, we're still believing that from a pragmatic and realistic standpoint, equities are actually offering one of the better bargains out there in an environment where most financial assets and hard assets are trading at very high prices because of the amount of money in the system. So looking towards the, some of the themes that are playing in the portfolio, one of the things we often try to think about, and as you can imagine, humbly so, we don't always get it right, but we constantly try to think about the fact that, as we've said to you before, money is made by discounting the obvious and betting on the unexpected. And so as we reflect back on what's happened over the past few years, this is an excellent reminder of some of the themes that we've all seen play out in financial markets. One of the illustrations of this is the commodity super cycle, as you could call it, because commodity cycles, like market cycles, typically are 4 to 7 years, and what we ended up seeing in Canada, as we can all reflect on when we think back to the cocktail parties in the early 2000s, is we ended up seeing just a spectacular cycle for commodity prices, whether it was the price of oil or whether it was the price of various metals, and it really continued into the 2010 timeframe. But now as you look towards the tail of this slide, what you can see is we've nearly come full circle. So this is really an index that measures commodity prices in a very wide spectrum of commodities. And you can see we've nearly come full circle. So how much of a surprise that might have been in 2006 and 7 when everybody was talking about the Chinese boom and how this would never end. One of the things that the Tradex fund, equity fund, provides us with as an opportunity when we have that concern that the market is getting ultimately quite complacent about an optimistic viewpoint, is we have the opportunity in this particular case, if that's reflecting itself in commodity prices, to try to step aside by shifting more of your capital into foreign equities. So although within Canada we're going to have to take positions within that very important aspect of the market, we can start to draw down profits in Canada and place those into the foreign equity allocation within the portfolio. And so you can see from back in that era when commodity prices were really sort of flattening out before they started to pull back in a very substantial way, the portfolio was prudently reallocating capital into foreign equities. And this has become, I think, ever more important as we go forward in terms of a diversifier. Today, we're thinking, as we look forward, about pruning some of those gains we've enjoyed in foreign equities and thinking about pulling some of that back into Canada. So those are things we're thinking about as we look forward. One of the things that we also talked about last year was a more constructive view on energy. We felt that there was certainly some room for further downside in the price of oil, but ultimately we were going to have some opportunities emerge from this. Oil kept on falling. This is showing you the full fall in the price of oil from peak to trough. Oil did keep on falling, but we're now starting to see on the silver lining side a great set of opportunities and some emerging recovery in the oil patch, which is exciting, and we think there's great potential for that to continue to unfold with volatility. So that would be an area we would consider putting more money to work. The other outcome of this has been, it was such a tough year in so many places that the central banks were pushing down harder on the gas pedal, which I think was a surprise to many. And as a result, an important allocation within your portfolio that was something we viewed as a contrarian allocation in the portfolio, so it fall in favor, was gold. So gold bullion was actually up about 13%. And although that doesn't seem like a lot relative to the commodity bust that we saw, that was a very important relative move, and it played out in your portfolio because most Canadian managers are underweight gold. So even within that commodity fallout, there was some silver linings. Looking forward, as we said, we are constructive on the potential for the energy sector. Timing is always difficult, and so we think the worst is behind us. It's difficult to know for sure, but we would note that energy is an unusual commodity in that it's ultimately got a very steady underlying demand. And so in this particular case, what's really caused the price of oil to fall has been oversupply. But the demand is growing fairly steadily, and if anything, there are signs it may pick up because of the stimulation from having such a low oil price. On the right-hand side, you can see an early indication that some of the supply issues may curtail themselves. So this is rig counts. You've probably seen this elsewhere. This is just signaling how much capital is going into drilling for new supply and new production growth. And you can see it's been an absolute cliff that in terms of the rollover in drilling rigs in the United States. And so the United States has had a key impact on this surplus of oil, and it appears to be starting to correct itself. So the markets are sniffing that out. We're starting to see the price of oil recovering. We do think that that's got some potentially good news for the stocks in your portfolio. We'll touch on that. When we look at some of the things we've talked about in the past, these are some of the key themes in terms of the differentiation of our approach. Certainly we benefit from a tremendous depth and breadth of resources at our firm, and so there's a tremendous set of resources for the team to take advantage of. We believe that the growth orientation is very important to the portfolio, so finding companies that have great fundamental momentum, regardless of the backdrop for the markets, that can help us move a little further ahead than we'll see the indexes. The bottom-up stock picking, we think, provides a much more repeatable way to deliver outperformance, and hopefully that shows up in the fact that portfolios are outperforming in good and bad markets against their peers. And one of the things that we think is also really important is not looking like the index. We recognize you have the opportunity to own an ETF that will replicate the index for you. So the opportunity that you have in the Tradex equity fund is to own something that's quite different, that's going to have a number of mid-cap stocks in it that have yet to be really discovered by the index and have yet to become substantial weights in the index. We're also going to do some of the things that will provide you with access to IPOs and issues in the marketplace that might not otherwise be able to be accessed by a fund of this size. So we're going to illustrate to you a couple of examples of that. And as we've talked about, we have the benefit of not being held hostage to the swings of the TSX that sometimes are determined by commodities. So when you look at the fund overall, we thought we'd choose this slide a little bit just to show you the bottom-up stock picking approach a couple of different ways, but it does also give you some sense for the Tradex equity fund overall. At the bottom you can see there's 87 Canadian equities in it. You can see the yield is about 3%. And so it tells you right away that there's a broad set of companies in there, and the yield's reasonably attractive relative to what's being offered within fixed income. In terms of what you're seeing on the left-hand side versus the right-hand side, what we're actually, I think able to draw your attention to is that if we look at the relative weight, what that means is that how different is the weight we hold in our fund relative to the benchmark, okay? So if the benchmark for Power Corporation weighting is say 2.5%, we're 1.3% more than the benchmark. But if you add up the top 5 there, for example, or just take a look at them, most of them are 1% or more. And yet when you look at our sector weights, the differences relative to the market is what that is showing on the right-hand side are quite modest. So at a total sector level, our weights are maybe 2% different than the market. What that's telling you is that the portfolio is really made up of bottom-up security selection. That is where the risk budget in the portfolio is allocated. And the reason for that is because we have a depth of resources that we want to try to exploit in order to get to what we think is more repeatable opportunities for performance, and that is through picking the right stocks as best we can. And so that's what we're really reflecting into the portfolio. We're going to have fairly modest sector exposures because we think whether energy stocks outperform or underperform, that is ultimately a riskier exposure to take in the portfolio versus trying to choose the best of the energy stocks. In terms of trying to illustrate to you some of the differences within the portfolio, what we've illustrated to you here is just the top 10 Canadian performers held by Tradex over the past 12 months. And so you can see in a market that was falling, there was a lot of opportunity for some spectacular gains in the Canadian stock market. Of course, this would have been even fantastic if this made up your entire portfolio, and we wish we could get it that right all the time. But this does give you a secondary sense, which is that look at how few of those names are household names. How few of those names would many Canadians ever recognize? These were holdings in your portfolio. Would they be in an ETF? Perhaps, certainly not in the size we own, and certainly not in an ETF which most would own if they owned a Canadian equity ETF, the one that mimics the S&P TSX 60. So none of these would have been held. And so there's that element to it. You can also see the richness in the portfolio in terms of sticking with some gold, which is typically out of favor for Canadian equity managers, and Detour Gold, Torex, Richmont. These were all very, very important to sustaining some better performance for the portfolio this year. So this is pertinent. On the other side of the ledger, we should point out that a former company that made this list a few times, Valiant, did stumble badly this year, and that was held in the portfolio. The piece of good news that we can highlight to you is that that company, similar to what you're seeing here, when it was making spectacular gains, was not a major weight in the TSX, and we were able to take profits, and as it fell this year, we were actually, we had exposure that was similar to the Canadian benchmark. And so it still hurt the absolute returns in the portfolio, but it wasn't actually a big drag on our relative performance, and we had taken the profits along the way. In terms of giving you a broader sense of, thinking about the composition of this portfolio and how different it is than the Canadian benchmark, we can also just give you a sense of the top 10 relative weights. So this is, again, this relative weight just means where we're taking a very different position than the benchmark. So if you lined up, for example, Royal Bank, middle of the right-hand side, so there's a household name for you. Royal Bank, it's 6.5% of the Canadian stock market, it's 7% in your portfolio, so it's actually our favorite bank right now. So that is a way to think about it. So we are 0.5% overweight. Now, on the other, in terms of most of the other companies, the reason why some of these are highlighted and bold and others are not is because it gives you a sense for how different our holdings are in terms of where we're taking our exposures in the portfolio than the benchmark. And again, you can see many of the TSX weights, or think of an ETF weight for a number of the companies in your portfolio, are very substantial, whereas the TSX weight is zero. And again, many names here are not household names. We'll touch on a few more of these as we go forward. A couple of things we were active in this year. We talk about the fact that we were fortunate to enjoy a good position to try to get a good stake in new issues that are attractive to us, given the market strength we enjoy as a firm. And so there was a couple of examples we thought we'd bring to your attention over the last couple of years that have been very important to the portfolio. The one on the left-hand side, Cara Operations, is not necessarily a household name in terms of its corporate name, but would be a household name to you if I mentioned to you that this is the company that, that owns Swiss Chalet, they own Harvey's, they own Kelsey's, Montana's, it goes on and on. If you're going out for sort of a, you know, a good quality dinner, the quick service, but it's not necessarily the highest end white tablecloth, chances are Care Operations owns this. And this company went public this year. You can see that, like the Canadian stock market, it had a rough ride. But the important thing is you can see it IPO'd at $23, and it is sitting today, you know, in the upper 20s. So it's been a good story for your portfolio when you consider how challenging the Canadian stock market has been. And we think it's a very attractive equity to own. We weren't alone in that. It was the most heavily oversubscribed issue, or most heavily sought after IPO that had been seen in the Canadian equity market in a very long time, because it's hard to get great consumer stocks in Canada. And in your portfolio, it's nearly 1% of your portfolio. It's very unusual. For many managers, it would only represent a few basis points. So that's an example. Another example we've talked about in the past is Element Financial, but that's trying to, you know, really take advantage of the opportunity we have to get, you know, into the front of the line on interesting IPOs. On the energy strategy side, I would imagine it would interest you, just considering all the volatility we've seen in energy, for us to speak to, you know, what's our strategy, what have we been trying to do? We've got ultimately a strategic position to try to ensure that we've got a spectrum of the market capitalization capturing the portfolios you've seen. And you can imagine when it's tough times for energy, one of the hardest places to have exposure is in mid-caps or juniors. And the good news is that I think we take hopefully a prudent view in terms of how we're taking our exposures. And we're trying to illustrate it to you here. Really, you can imagine your portfolio has Suncor in it, it has Canadian Natural Resources, it has some of the big major companies that we're all pretty confident are going to survive, but it also has a number of companies such as Raging River, Spartan, Tourmaline, you've seen them in some of the other slides, that aren't household names because they're intermediates. And really the focus for us, you can see it at the bottom in terms of the energy playbook, as we call it, is really to ensure we own companies that are going to survive at any point during the cycle, even when times are great and the markets are really buoyant about energy stocks. We want to own, within the intermediates, we want to take exposure to proven management teams that have made money for shareholders many times in the past. We want to ensure they're very well capitalized. We want to ensure they're low-cost producers and they have continuous production growth and reserve growth potential. And that'll help them deliver superior results in tough times, even when mid-caps are under pressure, and hopefully come out of the cycle in good shape. So how have they done? Well, the one-year performance, you can see most of the stocks are in red, with the exception of Raging River, which did an unbelievable job holding up. That was a tough period. The 1 year ended March 31st. How have they done since the trough? And so the trough was in mid-February. And since then to now, what you can see is some fabulous recovery in these companies. What is the one key element that's really helping them survive is, you know, or two key elements. Over on the right-hand side, you can see there's virtually no debt in these companies. So that really enables them to survive. And they've been doing a fabulous job growing production. So those are the kinds of things we think about. These are the kinds of companies you've seen us highlight in prior discussions for having really overachieved for the portfolio, and we're constructive on the outlook for them. And with that, I'm going to turn to Graeme to speak on global.
Okay, thank you, Andrew. Good evening, everybody. We have some news, some update on the foreign content within the portfolio, and it's a good news story. Historically, within the foreign content, it was US companies, it was European companies, and late last year, we made the switch along with management, along with the board, to actually truly go global. And so what does this mean? Well, this means that not only do you have US and European companies within your Tradex equity fund today, but you also have companies hailing from Asia, hailing from UK, and hailing as well from some emerging market countries that offer tremendous growth prospects going forward. And so it's nice to have a truly global component to the portfolio. And so on the top right-hand side, we see what this offers by going globally is it offers, wonderful diversification from a sector perspective relative to the Canadian market. We can see that the global universe of sectors of stocks isn't dominated by financials, by materials, by energy, as is our Canadian marketplace, and so it's nice and well-rounded there. As well, you get a great diversification by geography, and so as it goes, North America comprises the bulk of the global equity universe, but there's continental Europe, as I mentioned, Asia, and some emerging market exposure there as well. So greater diversification in terms of sectors, in terms of countries, so good news stories there. What's important too is the global stocks within the Tradex equity portfolio, you have 35 of them. So it is quite a concentrated mix of global stocks relative to the index that has 647. So we're doing a great work of identifying highly attractive companies to put into the portfolio, and it ends up looking a lot different than it would relative to an index, relative to an ETF. And so why is it important to go global with the allocation? Why is it important to invest globally? And it speaks to the opportunity set that we get by leaving the US, by really thinking globally. And so this example is representative of the automotive industry, and we have some other scenarios that we can point to in similar fashion. But if you were an investment manager, you were looking to buy a car manufacturer, a car company in the US, and you only had your US universe to look at, you would look at the blue dotted bubbles in front of you there, and you could invest in Ford, GM, or if you believed in the future of electronic vehicles, you could invest in Tesla. Stepping outside of the US, if you wanted to invest in a company within Europe, you could invest in the gray dotted companies, and there's a number there. And then further, going into emerging markets, you could also invest in Kia, in Hyundai, and whatnot. And so what this is illustrative of is when you step out and go global, you get a larger opportunity set of investments, you get greater selection of choice, which ultimately means that you can pick the company that you want to own relative to having to just restrict your universe or your selection criteria to the US. And why is this important? There's a lot of academic research that says, the greater the breadth within the marketplace, or the greater the opportunity set presented to you, the better chance you have of generating alpha. And alpha is your incremental return relative to the index. And so that's a fancy word of just saying, can you outperform the index? Can you do better than owning an ETF? Can you do better than owning an index? And when you have a greater selection in front of you, or a greater opportunity set in terms of breadth, it does prove that you will actually outperform the market, because you can concentrate your portfolio in companies you want to own relative to the overall index, and you can end up focusing on those higher growth opportunities, which is what we're doing on the global side of the portfolio. So to walk you through this slide, on the top is the S&P 500 index, so that's your US equities, followed by Canada, followed by a world index, followed by an emerging market index, followed by a European index of stocks. Various time periods looked at, but basically from anywhere from 1985 to present, we looked at the performance of the median manager within each of these markets, and we said, how did they do relative to the index? The US is a very tough market to beat. Historically, median managers dating back to the mid-80s have underperformed the US equity market. This is benchmarked against the S&P 500 index, which in and of itself is a very efficient index of very high quality companies that has a team that is responsible for rebalancing this index. Very hard index to beat. But shaded in that red box there, we have a look at the world index, we have a look at emerging market equities, we have a look at European equities, And the story is that these are larger markets, there's better selection, there's more breadth, and hence you can actually generate a positive return relative to the index. Importantly, you can do it consistently. So on the right-hand side of the page is a concept called batting average, and that basically speaks to if you are beating this index, how often are you beating it? And so we have a look at the MSCI World Index, you're beating it more than 50% of the time, good news story. Importantly, if you're investing in emerging market equities, you can almost beat this index every single quarter. So that's really what you're gaining by going global. You're gaining a larger opportunity set, and you're gaining greater consistency to generate outperformance relative to an index. And so in terms of what we're focused on from a day-to-day basis is, pardon me, so we should start with the team. The team managing the foreign content and global equities within the portfolio today resides in London. They are a highly experienced team. They're a large team that come from diverse backgrounds. The team is organized by industry because they truly believe that if you're investing in global companies, these companies operate globally. So it's less important to be a country specialist, it's more important to be an industry specialist as they operate across countries. The team is led by an individual named Abib Subjali. This team of 10 has been together for a number of years. As we'll see in a couple of slides, they have a tremendous track record of generating that alpha or that outperformance relative to the benchmark that I spoke of. Their focus day in and day out is on their investment philosophy is the 4 pillars of competitive dynamics. And so we have 2 companies here for comparison purposes, but perhaps first I'll start with outlining what the 4 forces of competitive dynamics is and what they're focused on day to day. And so they look for attractive business models that make sense, business models that prove themselves to be highly profitable and cash flow generative, and they're unique. They have an edge within their industry, they have an edge over their competitors, and in doing so, they're able to gain market share over the long term. And they want to make sure that while gaining market share over the long term, they're actually operating in end markets that are growing. Because at the end of the day, if you're gaining market share in a falling industry or an industry that's going obsolete, does that really matter? Not really. So you want to make sure your end markets are growing. And at the end of the day, management is very important in terms of guiding these public companies in intergenerational management changeovers, making sure that they have the same beliefs, the same focuses, the same cultures going forward, because that ensures a successful company will ultimately transition in a much smoother path and continue on with its success. So TJX companies, long-standing holding within the portfolio, they have a strong portfolio of brands, many of which we'll recognize, being Marshalls, HomeSense, Winners, and the like. Relative to Eastman Kodak, so the 4 forces of competitive dynamics that I spoke of in terms of TJX relative to Eastman Kodak, we can see there that based on TJX's history, their market cap's grown, their revenue's grown, their pre-tax income's grown. And that's directly as a result of being run by good management, having a great business model, having a great portfolio of winning brands. Relative to Eastman Kodak, the performance of Eastman Kodak has been quite volatile. They found themselves a number of years ago in an industry that was going obsolete, that was certainly slowing down. And so when you compare and contrast TJX versus Eastman Kodak, when you really drill down and analyze the 4 forces of competitive dynamics, one clearly stands out and one does not. And so that's why TJX companies have been a long-standing holding within the portfolio. And so quickly just touching on the track record of the team. This team has been together since 2006. This team has proven themselves through a variety of market cycles, and their performance is within the top box, ending March 2016 rather. But what you can see is that they've handsomely outperformed the MSCI World Index going back a number of years, which is important, and they've done so because they're a great team of individuals with a lot of industry expertise, and they have a clear investment process and philosophy, and we're happy to have that team at work today in the Tradex Equity Fund for the Global Equity component. And with that, thank you very much for your time. I know we always run a little late here. Happy to take any questions.